Welcome back to Morning Trade Live. It's time for the Meetup panel. Let's talk about some of the big events that are on the way this week. First, we're going to hit some geopolitics and then earnings. Let's bring in our guest. Michael McCurr is a strategist of institutional trading and education at Ameritrade. Alex Coffey, senior specialist on the retail trading desk. And Mr. Scott Bauer, as we know, a regular here on the TD Ameritrade Network, CEO of Prosper Trading Academy. All right, Scott, President Xi Jinping in China seems to be just pretty quiet on any possible, reconciliation or conciliatory tone in a speech given this weekend. So what's going on?
I'm very surprised to see how the market is kind of reacting to that. After the rhetoric last week back and forth that yes, President Trump said we've got something on the table. Larry Kudlow comes out, says no, we really don't. And now the news out of China isn't, I wouldn't say isn't so bullish for tariff reconciliation. That being said, the market really is kind of looking beyond that a little bit, I think. I would have expected a little bit more to the downside here. Maybe he's playing the game too. Maybe he's kind of stepping up to President Trump here and says it's not going to be, we're not going to roll over quite yet. Yeah. I do think it's going to happen, but I don't think we're rolling over quite yet.
Alex, should we be surprised by this? I mean, is he going to put anything out that's positive or, backing away before this G20 meeting?
I don't think so. I think we're going to have to wait until they actually meet and get something concrete. I think that the actions from what actually comes out of that meeting is going to be a lot more important than some of this rhetoric going back and forth. And he really didn't say anything that surprised me. I mean, what's he going to say? No, we're not going to promote a global economy. We're just going to isolate ourselves. No, he's not going to say that. So.
Yeah, and that's kind of the point that I'm glad you put it that way, because this is not a deep political analysis, Michael. This is just kind of logic. It's like if the market is waiting on some big news, you're probably going to have to wait until after this meeting.
I would agree with Alex in that it wasn't really anything revolutionary that he said. This really is only the third time that he's publicly spoken about China's economy since Trump was elected. So this conference that they have all of this week is about imports and opening up their economy to a more global and free trade. And this kind of goes against what China has really been doing, though. They're very protectionist, just like we are. They have their own state-sponsored companies and entities, and they block a lot of United States companies. So I'm not too surprised that he's being a little cagey with what's going on. But ultimately, like Scott says, there's probably going to be a little bit more positivity moving into the G20.
Scott, let's talk about the market relevance of this and just the overall scenario right now, because you've basically got the NASDAQ deepening its loss on the day. Apple's having a rough day. Amazon's having a rough day. It seems like it's just no matter how much we want to talk about these potential events, it's just zeroed in. And honestly, I'm kind of getting the blinders on too, Scott, because it's like, if tech doesn't stop dropping, does any of this stuff matter? Does tariffs really matter? Does midterms really matter? If you've got 25% of the S&P 500 now in a slide?
It does matter, because I think we're still in just a little bit of the sector rotation here, and we haven't hit rock bottom yet, but I do think it matters. I do think what comes out of the G20, especially this week, which is going to be post our midterms, is going to be very important. So, the market is going to be volatile today, tomorrow, probably Wednesday because of the midterms, and then you know what? Then it's going to be back to the task at hand. It's going to be back to business as usual. And what has business as usual been over the last few months? It's been really tariff talk and earnings, and we're going to be focused right back on tariff talk.
Yeah. Alex, you look at the Hong Kong index, down 2%, popped up last week a little bit, but it's just this downdraft now that is, maybe we could say for a while, oh, well, we're putting the pressure on China. They've already got slow growth. It's almost like now that catch-up game is finally being made between that very scary chart that many pointed out, which was pick a non-U.S. index, and it was down the past 6 months.
Yeah, we've kind of talked about that over the last month, 2 months, and one of the things we said is, that eventually feels like it's going to have to come back together because, historically that correlation's been there. But how are we going to get there? And it seems like how we're getting there right now, at least, is the pullback in our indices, not necessarily the recovery in theirs. And I think that was an area that a lot to look at. But I look at this today. You have the NASDAQ down 100 points, and you're still staying pretty flat in the S&Ps. I think Scott nails it there. It's more of a sector rotation than it is necessarily, weakness across the board.
So maybe it's a rotation, Mike, but the rotation, to your point, guys, 7 out of 11 sectors are higher on the day. But I mean, it's kind of a rotation. It doesn't really do much for the S&P 500, which is now basically flat.
Right.
Because the big stuff is comm services, discretionary, tech, and they're all lower.
Yeah, it's definitely a sector rotation, like both Scott and Alex are saying. I'm glad to see that the S&P is flat. It's kind of on autopilot as we head into the midterms. The VIX is staying right around 20. I think for us to consider, we're out of the woods. You want to see the VIX below 16, maybe towards the end of the week into the next week.
Yeah, Scott. What groups then specifically, when in this idea of rotation, have to be there? I mean, I imagine you've got to have good performance from the banks, which we do today, since it's the second biggest group of the S&P. Because I'm talking about this, SPY direction. Because obviously, if you're a trader, you like certain sectors and you're interested in that. But the broader rotation basically has only one or two places can go to kind of keep the market afloat, right? You got to have strength in banks.
The financials are key to me, and we've talked about this before. I mean, if we are going to break out of this range and at least get back to our recent highs, it's got to be led by the financials. Has to be.
Yeah. 10-year yields, though, don't seem to be a big driver of this. I'm curious about this, too, because, for example, today you've got the 10-year moving lower. Banks are up. This is not a daily correlation that you might have been able to look at 10 months ago.
It's not at all, and we've spoken about this many times that the 10-year and rates may have gotten ahead of itself over the last month or so on that big quick move up that we saw towards the 320-ish number and now has pulled off. I think it definitely got ahead of itself here, and we're in this very tight range now for the 10-year of 313 to 316 or so. But I do think that if banks are going to lead this, we may see rates moving higher as well.
Yeah, what's interesting about this is after we hit that high of 3.25, basically, we kind of drifted lower, but now we're right back up below 3.2. You're not seeing that kind of buying action come into bonds, Michael, like we did in just about every other sharp move up. February then went pretty quickly right back down over the next month in yields. It happened in the spring and summer. Then the Italian situation brought buyers back in. I'm looking around, and you don't really get that right now.
Because it seems like the Fed, after the latest employment report on Friday, that report was an awesome report. You had the 97th consecutive month of employment growth in the United States. That's got to be a new record. You had pretty decent average hourly earnings, and it kind of puts the Fed on autopilot for December, unless something to the effect of what's happened the last 4 weeks happens again. I think that they're going to raise the rates again.
Yeah. Alex, basically, I mean, we're going a little bit off the trade headlines here because, again, I think this becomes an important conversation, right? The overall pull of the NASDAQ, as you talked about that gap closing. If you're scared by basically like the 10-cent Facebook chart or the Amazon BABA chart, the fact that the Chinese version of U.S. tech keeps dropping lower as we're playing catch-up, I mean, it's getting a little ugly. Because if we're playing that catch-up game and they keep dropping, I mean, there's basically been no buyer that's come into tech right now for us or China.
There hasn't been, but if you look at just the chart that we have on the screen right now, I mean, we got a little bit, or I would argue a little bit ahead of ourselves on the upside too. I mean, we had an extremely strong 2017 that's getting lost in this narrative that, some of these stocks like Facebook went from, $90 all the way up to over $200 before they had these pullbacks. So they're still really strong relatively over the last couple of years. But if we could talk about just the interest rates real quick too, one thing that we haven't really mentioned is the 30-year actually made new highs last week where you're not seeing that. So you're actually seeing that curve kind of expanding a little bit too.
All right, guys, we're going to take a short break. We're going to talk earnings when we get back. We've got Scott Bauer with us. We're bouncing around this morning because the markets are bouncing around too. We'll be right back on the TD Ameritrade Network.
On Real Talk, I seek out the brightest minds in finance to discuss hot topics in the market.
Traders love to look at markets when they don't perform like you would expect.
Short and long-term investing strategies.
You save the money first, then it's already done and accounted for.
And talk with the most innovative leaders in business.
So it really means that we're the primary source of liquidity.
Tune in for Real Talk with me, JJ Keenahan, weekdays on TD Ameritrade Network.
I was playing golf a couple of days ago.
I love golf.
I used to love golf.
Wait, what happened?
I was having a good round, and then my friend, Sheila, right as I was stepping into the tee box, mentioned a tip a pro gave her.
No.
Yep.
Did it help?
It completely ruined my game.
Yeah, well, the truth is that advice was never meant for you.
I like you.
Do you want to show me your swing?
It's too soon.
Get advice that's right for you. Investment management services from TD Ameritrade.
There are multiple ways to edit a watch list on Thinkorswim. From the Market Watch tab, you can add new securities by selecting the symbol box in the last row, entering the symbol, and then selecting Enter. To remove a security, select its symbol, delete it, and then select Enter. To change the order of the securities in your watch list, select and hold a row, then drag it where you want it. To customize the watch list columns, right-click any column header and select Customize. To add columns, select an available item, then Add Item. Similarly, to remove a column, select it in the current set and select Remove Item. To save changes, select OK. New columns appear on the far right. Changes to the columns and order won't carry over if you view the watch list in a different part of the platform. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to the TD Ameritrade Network. I'm Oliver Rennick. I want to bring back in our panels as we talk a little earnings because it's not done yet. We've got over 100 companies left in the S&P 500. Scott Bauer's with us, as well as Michael McCurr and Alex Coffey of TD Ameritrade. Scott, I want to, as we talk earnings here, let's go back to our conversation real quick before we get into some of the companies we're all watching, because the tariff situation on earnings so far has basically been very specific companies, right? I mean, like, it's really hard to say there's been a big change. Maybe guidance would have gone up more, but it hasn't really changed much since the start of the year, except for companies that have specifically said so.
Right. You can't really look for earnings for an entire sector, per se, on how they were going to react to the tariff talk. It is really stock-specific, company-specific. Yes, like you mentioned, Oliver, we have had a few companies, just a few, that have come out and talked about tariff guidance, but it's really, really so stock specific. There are no generalities right now in this earnings season when it relates to the tariff talk.
Yeah. All right. What's your earnings to watch today? Because we got booking. Forward price line. Yep. You've got Kayak in there as well. Under the brand. We were just talking a little bit about the earnings preview. Why are you interested in it?
I like it. Expedia struggled a little bit, but I like Booking a lot because a good chunk of their revenue comes internationally. Okay. And when I was looking at some of the metrics here, it looks like not only some of the international bookings, but the international revenues where they see a higher percent of profitability from is actually up. Plus, they actually guided higher after the last quarter. So it's not often that you see a company come out.
Stock's been under pressure.
It has been under pressure. It has been under pressure, but it's not often that you see a stock come out, raise their own guidance, and then miss. So I'm looking at this one. The market, at least right now, I think is pricing in about a 7% move, about $130, I think it is, either way, which would put it right, on the upside at that magic 2,000 number. Now, if there is good guidance, if there is a good report to the upside, there's also some market psychology that plays into that because the market acts like a magnet when it comes to those big even numbers.
Bring up the chart again, guys. I find this fascinating that, and speaking of gaps getting closed, Expedia and Booking now are exactly even on their percent move year to date. TripAdvisor's basically taken off, but a lot of folks have focused in on the sort of tech and web-driven revenue of a TripAdvisor. Do you think about the fundamental here, Scott? Are you thinking about the consumer health, or are you just looking at the way this company is traded?
A little bit of both. I do like the way the company is traded, but I look at consumer health also. And you know what? Even in this last downturn, that over the last 4 weeks or so, we haven't really seen that consumer number, the confidence number, dip yet.
Great point.
Now, that may happen if this continues, but reported in these numbers here, we haven't seen that yet, and I think you're going to see a real strong number.
That's a great point, too, that despite the sell-off, that consumer confidence hasn't gone anywhere.
Right.
So some might say, all right, well, people are starting to freak out about the money they're losing, but I guess it's going to take more than 10%. This is a natural transition, Mike, because you've got your eyes on Wynn.
Right. I'm looking at Wynn this week. It is a stock that has been not winning over the last year. On the year to date, the gaming sector alone is down 22%, while Wynn is down a little bit over 33%. So it has been directly tied to the U.S. and China relations, as well as the China economic sector and the health of the economy over there. 40% of Wynn's revenues come from Macau. So this is an area where I'm really watching this week, see if it does find a footing. The market maker move is right around 10% for the week.
Wow.
So something I also was looking at is the 20 delta risk reversal, where we're looking at the calls versus the puts. It's a little bit tilted towards the upside. So last week we saw a massive key reversal in the stock on a weekly basis. So it looks like it's found some support.
It was really interesting because we had Macau numbers, and it depending on which coverage of this you read, by the way, some said it was a bad number, some said it was good, because you basically still have these annual declines in terms of how much gaming is happening there. but I guess thoughts maybe that some of the, it can't get much worse, I guess. I mean, at a certain point.
Right. It's definitely, it seems like what you just said, one person said it was good, one said it was bad. It's almost like a Rorschach test.
Yeah.
Whichever way you look at it, that's how it's going to be to one observer. I think based on all the things that we've seen, it might have caught some footing, and heading into the G20, there could be some positivity.
They all got bid up, Wynn, Las Vegas, MGM.
Right, 10% after that tweet by the president, it rallied.
So this is clearly one of those tariff plays then, maybe.
Yeah, absolutely.
Right. So you basically have got high rollers maybe backing away from the table. Alex, I like yours, all right? Let's talk a little gaming. Activision, why?
One, it's just one of those interesting. I like the stock just because it's an interesting. It's more of a millennial stock, I would say, just because it focuses on video games and new industry. But something interesting about this whole industry in general is you really got to hit a home run in this one.
Yeah.
36% of U.S. retail sales last year came off the top 10 titles. And it's even more so with Activision Blizzard. Their four big ones are Candy Crush, Call of Duty, Overwatch, and World of Warcraft, those were 66% of their revenues last year.
I'm glad you bring in the King Digital side, because that was an important acquisition that probably was behind some of the strength that they had. But then they pretty much have sold off with EA, despite having some of these big titles. I mean, what's going on here?
Well, so they've had steady declines across the board, all three of those. So the King side, Blizzard, and Activision as far as monthly active users, and that's going back across all three, at least the last 3 quarters. So if I'm looking for a number in particular fundamentally there is, does that level off or get maybe a sign of increase there? Because that has been a question mark for this company. But we're looking, as far as just numbers we're looking at a stock that's up 3% year to date, down about 20% off the highs. So it's followed the market for the most part. But we're looking for a 6% move according to the market maker move.
If we could put Activision, EA, and Take-Two guys on a chart here today, I like this as well from a sort of analytical perspective, because, Scott, when we talk about, there was actually a great Goldman report this morning about the importance of margins. So I don't know the margins of either of these companies off the top of my head, but as we see the market get volatile, Goldman's point was you have to go after companies that have the most price resilience, basically, in terms of what they can pass on to customers. And we see this dispersion intra-sector crop up a lot. Video games are a great place. Now, I think this is more about some of the title trade-off that you mentioned, but you've got Take-Two sitting near the highs on the release of Red Dead. You've got EA just dropping as they push back Battlefield, and they're basically, a rough guidance. This is a market where you're starting to see a break apart happening, basically, of all the constituents.
There's no question. You go back to that chart there, and like you said, you have EA down at the bottom, you have Activision right in the middle, Take-Two right on top. So, how do you evaluate the three of them against one another? And I think it's clear, much to what Alex said here, I think you said, 36% comes from the top 10 titles? I don't know those titles because I'm still stuck in the era of Pac-Man and Miss Pac-Man and Space Invaders, but I bet, looking at that chart there, those great titles are either with Take-Two or Activision.
Yeah, well, that's the Red Dead story.
And one
right
other thing that's a little bit of a question mark on this one too. One of their big, especially on like the console gaming side, is Call of Duty. And there was a big disruption in this last year with the Fortnite type of games coming out with the Battle Royales. But the big thing there was they offered that game as a free game. So people could just download it, and you saw how much of a disruption that's been. So now a customer has to make that decision. Do I want to continue playing this free game and buy the in-app purchases or the in-game purchases, or do I want to go to the store and pay $60 for Call of Duty? Yeah. And so it's going to be interesting to see how that plays out.
All right, I got to leave it there because I haven't played Red Dead in 3 days.